Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And with shares of Circle Internet Group, ticker CRCL, up 589% in less than a month, more than 6 times your money, investors are rushing into what could be a $2.4 trillion market opportunity after that Genius Act. But while everyone's chasing the obvious stock here, one overlooked giant is quietly positioning itself to be the Amazon of stablecoins. This company could dominate the space, and I'm going to reveal that stock to buy before it beats Circle at its own game for a 600% return. Stick around and we'll also see important updates to shares of Hims and Hers, Nvidia, and Supermicro, ticker SMCI. But first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Back to our main topic though, and shares of Circle Internet Group, ticker CRCL, rocketed 380% in just 2 weeks from its June 4th IPO, and then went into overdrive after the passage of the Genius Act in the Senate. Still waiting to work its way through the House, the act creates a pathway to legalization of stablecoins and a framework for regulation. That bill could usher in a new era in digital banking, which McKinsey estimates could reach $2 to $4 trillion in tokenized assets by 2030. Investors in those tokenized investments will likely use stablecoins to buy and hold the assets, so this represents a tremendous growth for the relatively small $250 billion market cap for coins like Tether and USDC. That sent shares of Circle up another 98% before giving back some of those gains over the last week. Circle operates the USDC stablecoin with just over $61 billion in circulation, or about 25% of the stablecoin market. How this works, investors trade their traditional currency, so US dollars, for USDC digital stablecoins, often used in crypto trading. Circle takes that payment and then buys assets to back up those stablecoins, so it maintains a one-for-one, a $1 relationship with the US dollar. The asset it buys is usually US Treasuries, so that does two things for Circle. One, the interest rate it earns on that US debt is its profit while it holds the debt, but it also has a rock-solid backing for the USDC stablecoin, maintaining that one-for-one peg with the dollar. I warned investors that shares of Circle were getting a little too expensive here in last week's update. There is little or no analysis or forecast for the stock, but we can look to the company's filing with the SEC to see this. On revenue of just $1.6 billion last year, investors are paying a very expensive 29 times price to sales. But even more worrying here is the company is only growing sales by 15% a year and booking a 10% operating profitability. And while growth in the stablecoin market is likely to take off, Circle is basically a bank making its money on that interest rate spread, and profitability is going to limit its earnings growth. Worse though still is, anytime you have a market with potentially 12-fold growth, you're going to see competition, and it's brought out what could be a leader in this new stablecoin era. Fiserve Inc., ticker FI, announced last week a plan to launch its own stablecoin and platform for clients, and versus newbie CRCL, Fiserve has the reach and the connections to dominate this space. The company is a fintech powerhouse processing trillions of dollars in payments, digital banking, and services for more than 10,000 institutions and millions of retailers. Fiserve is in the background of nearly every financial transaction you make. The company's platform is going to be compatible with other stablecoins, working with companies like Walmart and Amazon that have already said they want to build their own stablecoins. Is going to allow for an instant connection across Fiserve's entire network. So here you have that rare time when a legacy powerhouse is actively embracing technological change, and the combination of Fiserve's established connections with this new platform means it's here where you're going to see stablecoin go mainstream. While questions still come up over Circle's management of its assets and its ability to maintain that dollar peg, Fiserve has the credibility from operating for decades in the financial background. While Fiserve's revenue is only forecasted up 8% this year at Next, I think that is underestimated, especially once the stablecoin platform is developed, and the profitability on this one is leaps above Circle. Fiserve converts more than 30% of its sales into operating profits, 3 times the margin for CRCL. And instead of paying that $27 for every dollar in sales for a share of Circle, shares of Fiserve are trading for just 4.7 times on a price-to-sales ratio. Not only is that a discount to where it's traded at in the past, but if we do get massive stablecoin growth, investors are going to re-rate this to a multiple of 8 or 10 times. That would mean even on $22.5 billion in next year's expected sales, at a 10x price-to-sales valuation, that would be a $225 billion company, or a $407 share price. That is a 136% return and doesn't even account for revenue growth from stablecoins. But then a way to boost your return on this, because this isn't on Wall Street's radar yet, got an options play that could amplify that to an 800% return over the next 18 months. If we go here to the options available on Fiserve, and I'm using the January 2027 call options to give the stock time to break higher, we see that because Fiserve is a stodgy, old legacy financial company, nobody expects it to surge higher, and the premiums on the call options are very low. Expecting that to change, we can set up a bull call spread, buying the $230 strike price calls for $10.35 each, and then offsetting that, selling the $250 strike price for $8.10 each. That means our total cost is just $2.25 per share for a spread that is worth $20 each if shares of Fiserve go past $250 each over the next 18 months. That would be a 788% return on your money, and the beauty of this is, Fiserve only has to run 45% to that $250 stock price to get that return. That's just one of the 29 option strategies I use to boost returns and create income. But if you want to see the rest here, along with our options finder to make sure you're using the best strategy, and the calculator to see exactly how much you can make, I'm keeping open the relaunch window to our options course. Look for the link below and get $150 off and a 14-day free trial. Looking at the stocks I'm watching this week, Hims & Hers Health, ticker HIMS, plunged 35% after Novo Nordisk terminated its deal to sell the popular weight loss drug Wegovy. Those shares did claw back some of that loss to close 24% lower on the week. Novo accused Hims of pushing the cheaper copycat drugs to patients and putting safety at risk, while Hims has responded accusing Novo of pressuring it to steer patients to Wegovy, even when there was a better alternative. This issue comes from the compounding pharmacies that, because these weight loss drugs like Wegovy couldn't meet supply demands earlier in the year, were allowed to produce those legal knockoff versions. That meant telehealth companies like Hims had a field day selling these, with the stock up 354% in the 5-year period. But now that Novo and Eli Lilly are saying their production on these patented drugs is meeting demand, there's a question mark around whether those alternative versions of the drugs are legal. And now while that 35% drop brought out the value investors, I think you need to be careful here. Even after that hit, the stock still trades at over 6 times on a price-to-sales basis, which is expensive versus where it's traded at over the past year, and for what amounts to be an online retail pharmacy. Here, even if the company can meet its 58% forecasted sales growth to $2.3 billion this year, which might be difficult now with some of the patients going elsewhere for that Wegovy, even at that, the stock would still be priced at 4.4 times sales multiple, which isn't really cheap. Now granted, Hims was already doing great even before the Novo partnership, which has only been announced 2 months ago anyway. Management's guidance of $2.3 billion in 2025 sales was built on approximately 30% from weight loss drugs, so this isn't the whole business, and growth is still there. It might have some rebound more to go, but I'm going to be waiting for a bigger dip to buy on this one. Super Microcomputer, ticker SMCI, also plunged 12% last week when the company reported a $2.3 billion issue of convertible notes due 2030. Now, these are bonds, but with the option to convert into a stock at a set price, so potentially diluting existing shareholders. I read through the deal, though, and immediately rushed to buy another 1,500 shares at $42 each, bringing my total to 26,200 shares in just one account, by far my largest position, over $1.2 million worth, and up $400,000 so far. And that's because those bonds were a very good deal for SMCI, providing $2.3 billion in cash at a 0% rate for 5 years, and a conversion of $55 a share. Now, on top of that, the company is buying call options on the stock to take some of that possible dilution impact off of the shares. I realize the jargon might sound like a foreign language, but all you have to understand here is that this is a company dominating the biggest growth theme right now, the AI data center build-out, and it's expected to grow sales by 48% this year and 34% next to $30 billion. And is trading at just 1.4 times on a price-to-sales basis. Ridiculously cheap. In fact, as I pointed out in a video 2 weeks ago that I'll link to in the description below, this is the cheapest among the 60 AI-related stocks I'm following. This stock could jump 100% and it would still be a good deal, which is why I'm loading up now and how it managed to jump 8% last week even off of that news. Enphase Inc., ticker ENPH, jumped 17% last week after I recommended it in Monday's market update as the best alt energy stock right now, really the only safe one in the massive sell-off for solar stocks. There is still some talk in Congress over relaxing those solar tax credit expirations in the budget bill, but this industry is going to be on life support for the next few years, and I recommended investing only in the safest names. For that, Enphase is cash flow positive in operations and free cash flow, which means it can take a hit that most other solar names can't and still survive. Even on the bounce, though, shares are still attractive here at 4.2 times on a price-to-sales basis versus an average of 8 times over the last year. Now, I do think we're still going to see some relaxation on those tax credit expirations. Otherwise, America is just going to kill off its solar industry and give control to China, which nobody wants that. And Enphase here is going to benefit. Nvidia Corporation, ticker NVDA, hit another all-time high last week, putting a $4 trillion market cap in its sights. And while the chipmaker is going to continue to dominate that AI theme with a 53% sales growth expected this year, investors need to reassess their expectations. If you're expecting this stock to 16 times your money like it's done over the past 5 years, think about this. Just to 10x the current price, Nvidia would have to grow to a $38 trillion company. That would be bigger than the entire US economy at $27 trillion and damn near as big as the US and China combined. On forecast for $250 billion in sales next year and a price-to-sales multiple of about 20 times, you can probably count on a solid 30% return, but the multiples on your money are just not going to happen. That's why I'm now looking at the next generation of AI stocks like Symbotic, Shoutout, and SoFi Technologies. Showing you the bigger picture here with the Sector Spiders Sector Tracker. 8 of the 11 stock sectors closed higher last week, and what surprised me most was not the strong upside in technology, communication services, or consumer discretionary stocks, which typically do well when the market jumps, but that financials and industrials did so well also. Both sectors are outperforming the market for the 1-year period as well. In fact, are the first and third best performing sectors over the period and could continue that momentum on deregulation. Oil stocks were the obvious losers last week, with a 13% plunge in the price of crude, sending the sector down 4% and taking it back into negative territory for the year. Oil at $65 a barrel puts it back into the low end of the range crude has traded at over the last year, though it did slip briefly to $60 a barrel in May and could again with a recession. The dip in the price, though, makes this a good time to buy those discounted names in the space. Not only did the dip improve the dividend yield on names like Diamondback Energy, ticker FANG, but it also took the stock to an 8 times price-to-earnings valuation, a solid discount for long-term investors. Updating our stock market outlook, it is a holiday-shortened week with the U.S. markets closing at 1 p.m. on Thursday and closed Friday for Independence Day. Even with the monthly jobs report on Thursday, it's likely to be a quiet week with maybe an upward bent to that momentum. We still do have a week before expiration of tariff pause and another week still for the second quarter earnings, so investors are firm in their buy-the-dip mood, which means that market is going to continue to build on itself. The monthly non-farm payrolls report is expected to show a gradual weakening in the jobs market, with just 115,000 jobs created last month versus 139,000 the month before. Now that said, every call for a job slowdown over the past 2 years has been met by surprisingly high numbers, and there's nothing to think that changed drastically last month. A strong jobs picture is going to keep the Fed on hold, but it's still good for the outlook on stocks. More importantly here, a chart on Yahoo Finance reminded me that probably the most important 2 lessons in investing. That 1, overthinking the market can be dangerous. Most of the time, the best strategy is just to stay invested for the long term. Those of you in the nation know I spent more than a decade as a professional analyst, and I know the market can make complete fools of us forecasters. While I did expect the market to fall on tariff news and warned investors twice in the last week of March, nobody could imagine the speed at which stocks rebounded to set new highs. And it was no different on Wall Street. Analysts were falling all over themselves to downgrade their year-end forecasts. To spare them the humiliation, Yahoo Finance removed the numbers here below 6,500, but I put that scale back. After stocks crashed, JP Morgan was calling for the market to finish the year down 15% from its high, a full 20% from its forecast at the start of the year. Now, of course, nobody can forecast the next tweet or how it's going to affect the stock market, but that scramble to back up to cover up those mistakes reminds me that you should never change your overall investing strategy 180 degrees on any news. You might take more protection with options or up your investments in safety bonds and assets a little bit. It's this kind of knee-jerk reactions to the news like this that are going to lose your money. Find those companies and the stocks you really like. Stay invested and you will make money. Get your $150 discount with a coupon in the description below and learn how to use options to boost your returns and create income. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.